Welcome to this special property-themed episode of the weekly briefing from Capital Economics. I'm David Wilder. It's July 23rd. It's been an extraordinary few years for commercial real estate. The 1-2 punch of the pandemic and its impact on working patterns, and then a generational spike in interest rates have pulled the rug out from markets across the US, UK, and Europe. But central banks are cutting or getting ready to cut rates, and these markets have already undergone a pretty painful adjustment. So is their outlook looking brighter? Is a recovery in play? And if so, how strong and where in the world will it be strongest? The real estate team at Capital Economics has been looking closely at the comparative performance of US, UK, and European markets. And to find out who's set to lead and who's going to lag, I'm happy to say that Kiran, Raichura, and Amy Wood from the team are with me today. Kiran heads our commercial real estate team, and Amy leads our coverage of the European commercial market. Hi, guys.
Hi, David.
Hi, David.
Kiran, let's start with you. The US, UK, and Europe, we've seen big falls in capital values across these markets. For some, it's been a uniquely painful adjustment, hasn't it? I mean, is that process now over? Talk about where we are and talk about specifically recoveries.
So the biggest falls so far have been in the UK, where all property values are down around 22%. And the UK saw an especially fast fall, particularly in the second half of 2022. The other regions not down quite as far at this point, so more like 17 or 18% to the end of Q1. But they have been catching up to the UK in recent quarters. Essentially, where things are at the moment, we think the UK values are bottoming. Actually, the latest data point to slight increases in values in the last couple of months. But on the other hand, in the US and the Eurozone, we're expecting to see values continue to fall for the remainder of this year. Broadly speaking, we think that reflects appraisals being marked down relatively slowly, partly because we think there are bigger debt issues in those countries and regions. And we think that means that in some cases, lenders and investors are to some extent putting pressure on valuers not to mark values down as far as they maybe should be. So in terms of what we think is ahead for those two regions, we think the Eurozone has maybe another 5% of value falls to go. In the US, that figure we think is more like 15%, which is still quite substantial. And that's largely because we think the office sector in the US is going to see a much bigger downturn than the other regions, for that sector, we expect to see a fall in values of 45% peak to trough.
So the expectation of lower interest rates doesn't sound like it's going to bring much relief to that market.
No, broadly speaking, our view on rates is, in terms of the relation to pricing, is that it's more about the 10-year bond yields, and across the board, really, we don't see massive drops in those yields. So as a result, we don't see a particularly quick recovery, but also we don't expect to see a particularly strong recovery even when that does come. And that also applies to the UK. We're not expecting to see a boom in values in the UK as we have following previous downturns.
Amy, let's bring you in here. I mean, when we do get these recoveries, what kind of returns are we going to see in these markets? Which ones do you think are going to lead and which ones do you expect to underperform?
Yeah, so I'll first focus on performance over the next 5 years. The faster pricing correction in the UK has actually left it pretty well placed for the early phase of the recovery. And we think it looks set to do comparatively well over the next 5 years. In contrast, the US looks likely to lag, given the slower adjustment to past rises in interest rates and the sharper hit to office values that Kiran's just mentioned. In terms of numbers, we forecast UK returns of 7.5% over the next 5 years. And this compares to 4.5% in the Eurozone and just 3% in the US. I think the big picture here is that across all regions, the recovery is pretty weak compared to the post-GFC period. And there are really two key reasons for this. First, these structural changes dragging on occupier markets, especially for offices. And second, the higher interest rate environment really limiting the scope for yield compression.
But nonetheless, it is surprising, isn't it, that the UK is going to be the outperformer in the coming years, given what we know about the strength of the US economy. Certainly, it runs at odds with what we've been saying more broadly about the relative performance of the US economy, but also with the mood music that's been playing of late in the UK, right?
Yeah, that's right. And I guess that's why we should differentiate, between kind of the next 5 years and the longer term environment, because actually in the longer term, we do think it's the US that's going to come out on top. As you mentioned, economic growth is forecast to be strongest, and this will be a key driver of rental and capital value growth. Meanwhile, the higher yield environment in the US results in stronger income returns, boosting total returns. What's quite interesting here, I think, is the conclusion is different to what we expect for US equities. We think they will underperform as the bubble which is building in AI stocks bursts, and they're not likely to do any better than the other regions once the dust settles. So some near-term weakness in the US, but longer-term, the outlook is still relatively bright.
Right. Kiran, you mentioned GFC. What about this issue of distress? We're continuing to hear about market defaults, about limits on fund withdrawals, about waves of CRE loans still coming due. Does all of this noise translate into a major market correction with knock-on effects, as we saw 15 odd years ago? Wouldn't we expect something calamitous given the size of all these exposures?
The short answer is we don't expect to see anything like what we saw last time at the overall level, and particularly in the UK and most of Europe. We've seen these reports recently of even some AAA bonds making losses, but for us that kind of reflects two main things really. One is that yes, there's probably an element to some extent that they were incorrectly rated, but the kind of broader and bigger point is that we've been warning about distress for a fair while, but we've been talking about pockets of distress, and I think that's what these losses on the AAA bonds are really reflective of, where we've seen certain sectors, German residential, UK shopping centres, US offices, which would be right up there as the three kind of regions and sectors we would be concerned about. I think it's fair to say there is a broader point with distress that we do still expect to see further losses on both CMBS loans, but also more bank loans, which so far have been pretty unaffected according to the data. In the US, that's where we see the biggest concern, and that's pretty much in two main sectors. Apartments being one of those, largely because they've been heavily transacted in recent years during the kind of boom years around the pandemic and immediately post-pandemic. So there's a lot of apartment loans that are due for refinancing, having seen a big ramp up in interest rates. And that's at the same time as we've got this massive supply boom in US apartments and 300% plus increases in insurance costs in some of those kind of coastal markets in the US. And we're seeing that come through in terms of more signs of distress in floating rate loans, whereas for fixed rate loans, it kind of depends on when they become due. And then the other sector that I, of course, mentioned earlier is offices, which broadly speaking, is affected like every other sector in terms of a rise in rates, but it's more about the big drop in demand in that sector. So we are seeing, some of the poorest buildings seeing big falls in demand and looking like they're probably not going to work as offices going forward. And we've done some work in terms of thinking about the amount of demand there is for office space out there, or will be, I should say, by 2030. And even though in the US, we've had this strong growth in office-based jobs in the last few years, and we expect that to be reasonably strong going forward, that does offset some of those losses. But even then, by 2030, we think that office demand will be around 1% to 2% lower than it was in 2019. So that basically leaves the 2020s as a lost decade for office demand, which is obviously completely unexpected thing going into the pandemic, and something that's really going to weigh on office values and office loans over the coming few years. We think there's a long way to go in terms of delinquency rates for offices still, which we think for CMBS will reach into the double digits in the coming months.
But nothing systemic within that. I mean, obviously extreme levels of distress in these pockets of distress that you describe.
That's right. And, there will be some lenders that are obviously more affected than others. And, we know that some of the regional and smaller banks have made more loans, or their loan balances have grown more in terms of commercial property loans. But we don't expect, particularly major banks to have any major issues here because they have been well regulated in recent years. It's the smaller banks that haven't really had that, and probably some of those will fail in the coming years.
Right. I can't let you go without talking about the impact of elections. Amy, I know you've been doing some work on this. To what extent does the political uncertainty either side of the Atlantic affect what's happening on the ground? Are we seeing activity being affected? And if so, where is it most acute?
Yeah, so definitely, in the UK now, we have reached a period of political stability that's probably not seen for some time. In contrast, in France, after the second round parliamentary election, it's still not clear what type of government will be formed. And there's still uncertainty also about the presidential election in 2027. And even in the US, Trump is leading in the polls, but there's still little clear info about what the plan for policies are. So I guess on the political front, at least for property, the investment environment does appear more supportive in the UK for now. But it's actually quite hard to disentangle the impact of political uncertainty on property markets, not least because it also has broader consequences for interest rates and the economy. And actually, these are the things that tend to be the more important drivers of property markets. If you look at the spread, for example, between prime central London and Paris offices, this is actually narrowed even before these political developments. And I think this really reflects the key driver of property performance going forward will still be economic and interest rate outlook. And as I talked about earlier, this really leaves the UK the top performer over the next 5 years.
Thanks, Amy. Thanks, Kiran. As I said at the start, they've done a load of work on the comparative performance of major CRE markets, including a global chart pack, which is basically the 14 charts you need to understand what lies ahead. I'll add that and other key bits they've done to the podcast page. Do get in touch if you'd like to know more about our real estate coverage or any aspect of our service. I'll be back with Neil Shearing in the coming days for our weekly podcast to talk about the latest in global macro and markets. But until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.